In 2012, a 29-year-old warehouse worker in Ohio named Marcus was sitting in his car outside a Walmart parking lot, staring at his bank account. He had just finished a 10-hour shift moving boxes, his lower back hurt, and his checking account showed $214.67. That same week, his rent increased, gas prices were rising, credit card debt kept growing. And like millions of Americans, Marcus believed the only way to become rich was to work harder than everyone else. More overtime, more stress, more sacrifice. That is the belief most middle-class Americans grow up with. Work harder, earn more, repeat forever. But what Marcus discovered years later completely changed his life. Because the people quietly building massive wealth in America were not always the smartest people or the hardest working people. Many of them simply understood one thing ordinary people ignore: time can work harder than humans. That sounds boring when you first hear it, but financially it changes everything. Today, Marcus is worth over $430,000, not because he created a startup, not because he became famous, not because he traded crypto every day. He simply invested consistently and then mostly stopped touching it. That is the uncomfortable truth most people avoid. Wealth in America is often built through patience so boring that average people cannot emotionally tolerate it. And in today's society, patience feels almost illegal. Everyone wants fast money. TikTok traders, luxury lifestyles, viral side hustles, overnight millionaire stories. But behind the scenes, the real wealth machine continues operating quietly while the internet stays distracted. And the craziest part? It requires almost no effort once it starts. The laziest way to turn $10,000 into $400,000 is not glamorous. It is psychologically difficult because humans hate waiting, but mathematically it works. That is why in this video, we are going to break down how ordinary Americans slowly build serious wealth without constantly working themselves to exhaustion. And if you are new here, subscribe to Andrew Finance, because this channel is about the real psychology of money, wealth, and survival in modern America. Now, here is where things become uncomfortable. Most people think investing is complicated because Wall Street wants it to sound complicated. Financial media makes money by keeping people emotional. Every day there's panic, market crashes, recession fears, political drama, economic collapse headlines. But zoom out over decades and something shocking appears. The American stock market historically keeps climbing because the entire system is built around growth. Companies expand, technology improves, prices rise, productivity increases, and investors who simply stay invested often outperform people constantly trying to predict the future. This is where the lazy strategy begins. Imagine someone invests $10,000 into a low-cost index fund tracking the S&P 500. Historically, the average annual return has hovered around 10% before inflation over long periods. That means without actively trading, without studying charts daily, and without constantly checking financial news, that money quietly compounds year after year. Now, obviously, markets fluctuate. Some years are ugly, some years feel terrifying. But the people who became wealthy through investing were usually the ones emotionally strong enough to keep sitting still while everyone else panicked. And psychologically, that's harder than working overtime. The strange thing about wealth in America is that most people can physically earn enough money to improve their future, but emotionally they sabotage themselves long before compounding has time to work. That is the hidden battle nobody teaches in school. Finance is not only math, it is psychology. Because the moment people see their investments drop, fear takes over. In 2020, millions of Americans panic sold during the market crash. Headlines screamed economic disaster, businesses shut down, people lost jobs overnight. Fear dominated society. Many investors pulled their money out, believing the system was collapsing forever. But while average people were panicking, experienced long-term investors quietly kept buying, and years later, the market recovered dramatically. That moment exposed the difference between emotional money behavior and rational money behavior. The lazy path to wealth is not really lazy emotionally. It simply removes constant physical effort. Instead of trading every day, successful long-term investors build systems that continue operating while they live their normal lives. Think about how strange this is psychologically. A nurse working double shifts in Texas, a truck driver in Ohio, a teacher in Florida, a warehouse employee in Arizona. Many of them could slowly build more wealth through automated investing than someone constantly chasing risky shortcuts online. But society rarely celebrates slow success because slow success does not look exciting on social media. Nobody posts a viral video showing 20 years of patience. They post rented Lamborghinis and fake luxury instead. That illusion traps millions of young Americans into thinking wealth must happen quickly or not at all. But historically, the people who quietly became financially secure often followed boring routines consistently for decades. Here is where compounding becomes almost unbelievable. Let us say someone invests that original $10,000 and then contributes just $500 every month into a simple index fund, averaging long-term market growth. Over 25 or 30 years, the growth becomes massive, not because the person worked harder every year, but because time multiplied the money repeatedly. That is the part most people underestimate. Compounding looks weak in the beginning. In the first few years, growth feels painfully slow. Many people quit there because humans naturally crave immediate rewards. But eventually, the curve changes dramatically. The money begins growing faster than the contributions themselves. And once that happens, wealth creation becomes less dependent on labor and more dependent on ownership. That is how many Americans slowly escape financial stress without becoming celebrities or entrepreneurs. They simply own productive assets long enough. Warren Buffett became one of the richest men in the world largely because compounding had decades to work. Warren Buffett, most of his wealth came after age 50. That completely destroys the fantasy that success must happen young. Yet modern culture pressures people into feeling late by 25. The reality is most financial success stories are painfully slow in the beginning, and that slowness filters out impatient people. If you're enjoying this video so far, hit like, subscribe to Andrew Finance, and comment below how old you were when you first started thinking seriously about money. Because for many Americans, financial awareness only begins after debt, stress, and survival pressures force them to wake up. And honestly, that is becoming more common in modern society than ever before.
One of the biggest financial lies Americans quietly believe is that high income automatically creates wealth. But if that were true, millions of six-figure earners would not feel financially trapped right now. Across America, there are people earning $120,000 a year who still live paycheck to paycheck, not because they are irresponsible necessarily, but because modern lifestyle inflation silently consumes income faster than people realize. Bigger apartments, expensive car payments, subscription overload, rising healthcare costs, constant online shopping, social pressure, luxury vacations financed through debt. In today's society, spending money has become emotional entertainment. People are exhausted, stressed, and mentally overwhelmed, so consumption becomes a coping mechanism. And financially, that creates a dangerous cycle. The reason the lazy investing strategy works is because it forces money into assets before lifestyle inflation can destroy it. Automation removes emotion from the equation. That is the hidden power most people overlook.
When investments happen automatically every month, people stop relying on motivation or discipline. The system continues operating quietly in the background while life moves forward. That matters because human emotions are inconsistent. Some months, people feel financially focused. Other months, they feel depressed, impulsive, or distracted. Automated investing bypasses those emotional swings. And psychologically, that may be more important than investment knowledge itself. In fact, many financial experts believe behavior matters more than intelligence when building wealth long-term. A person with average financial knowledge but consistent investing habits will often outperform someone constantly chasing perfect opportunities. Think about what happens every year in America. New financial trends appear non-stop: meme stocks, crypto hype, AI stock mania, economic fear cycles, political panic. And every trend convinces people they must act immediately or miss out forever. That fear of missing out destroys more investors than market crashes themselves, because emotionally, humans struggle to stay patient while others appear to get rich quickly. But most overnight success stories disappear quietly later. The boring investor rarely becomes viral online, but financially, they often win long-term. Imagine two friends starting at age 30. One constantly jumps between trends, trying to double money quickly. The other simply invests monthly into diversified index funds and leaves it alone. 10, 20, 30 years later, the second person often ends up wealthier with far less stress. Why? Because consistency usually beats emotional decision-making, and that becomes even more important during economic uncertainty. America in 2026 feels financially exhausting for many people. Housing costs remain high, food prices continue rising, insurance costs hurt families everywhere. Many workers feel like they are sprinting financially just to stay in place. That pressure makes fast money fantasies more attractive than ever. But ironically, desperation often pushes people into bad financial decisions. The lazy wealth strategy works because it accepts reality instead of fighting it emotionally. It does not promise instant riches, it promises gradual ownership, and ownership changes everything financially. Because once assets begin generating growth consistently, your survival becomes less dependent on physical labor alone. That is why older wealthy Americans often prioritize investments over flashy income. They understand freedom comes from assets producing money while they sleep, not from endlessly trading time for paychecks forever. If this video is changing how you think about money, subscribe to Andrew Finance, because most financial problems today are deeply connected to psychology, identity, and modern American culture. And understanding that may matter more than any stock tip you will ever hear online.